Bismillah ar-Rahman ar-Rahim. Welcome to the second day of the Arab Pensions Conference 2021. This is the second day of the event. Yesterday we had a very interesting opening by His Excellency Sheikh Mohammed bin Abdullah Al Khalifa, then the Minister of Finance of Arab Republic of Egypt, Dr. Mohammed Mu'it, and then after that we had very excellent three sessions on demographics and longevity risk. And then we had another session on how to enhance and expand pensions coverage in the Arab world. And last but not least, we had a fantastic international session, I would say, on lessons learned from the COVID-19 crisis, especially in relation to social insurance systems and social protection. They were very informative, very lively panel discussions. Today we continue this with another two fantastic sessions. The first one is on the investment returns expected by pension funds in the coming 20 years and maybe in the coming 5 decades, because this year we almost celebrate the 50th anniversary across the region of the establishment of pension funds and social insurance systems. The current and prevailing investment environment is not what it used to be. It brings a lot of dynamics and challenges, and this is what we are going to hear about and discuss in the immediate session after this introduction. And after that, we will have this focused discussion on the significance of fintech or maybe pension tech, and how it can be part of the dynamics of the part of the toolbox to reform, to enhance the landscape of pensions and social insurance in the Arab world. And that would be the second session. Without further ado, I now invite the moderator, Mrs. Farah Fusto, our competent and interesting chair for this event, to take over the mic. Thank you and enjoy the day.
Good morning, good afternoon. Welcome to everybody. Thank you so much to our organizers for hosting us today. We've already had, I think, 1.5 days of this session, and it's sure there are many insights that are coming through. I'd like to introduce my esteemed panelists. We have with us Her Excellency Ms. Khulud Al-Sakaf, who's the CEO and the Vice Chair of the Board of the Social Security Investment Fund in Jordan. We have Mr. Abdul Latif Al Saif, who is the founder and MD of Sabine Investments, formerly the CEO of Al Raida Investment Company, which was under the Public Pension Agency of Saudi Arabia. We have Dr. Alistair Vine, who's with us here, I think, based in London, who is the MD and head of retirement strategy and UK distribution for State Street Global Advisors. And we have with us also Karim Shadid, who is the head of investment strategy for iShares EMEA at BlackRock. Thank you all for being with us today. Looking forward to this interesting discussion. And let me just start by maybe laying a little bit of the landscape. We're seeing inflation or consumer prices October 2021 were 6.2% higher than they were a year ago, and I believe it's the highest year-on-year price inflation since 1990. So, what is causing this, the actions that pension funds and institutional investors around the world are forced to pivot, what is the impact on our industry. We've just been through 18 months of a pandemic, the greatest shock to our economies since World War II. And clearly this has had a lot of impact on the swings in demand and supply around the world. So, I think here it's interesting to see that we have people sitting from different sides of the table. We have individuals that are sitting from the provider side, the solution providers. We also have individuals that are sitting from the fund side and understanding the challenges that they will be facing. And maybe if I can go to Your Excellency first to start, we've seen that the impact of the pandemic that's had on many economies around the world. Could you talk to us a little bit about the impact on the Jordanian economy, on the people, how that's related and affected the way that you manage the fund? You mentioned the constraint in your conversation before the panel around local allocations and the need for new tools. So I wonder if you could possibly give us a little bit of light and background as to how the fund is actually intending to address some of these challenges, and if policies need to adjust, and how you potentially will meet future liabilities. Thank you.
Thank you, Farah, and good morning to all. I want to thank the organizer at the beginning for this valuable conference. We meet again at this time of the year to further discuss our perspectives, our pensions, positions, and our future economic outlooks. I'm really honored to be here virtually surrounded by great people from the entire globe and from the Arab world in particular. Like most countries around the world, the pandemic affected the Jordanian economy negatively. The shutdown of almost all sectors for several months, the cut of salaries has caused a decline in aggregate demand, which basically led to negative growth and higher rates of unemployment. In addition to that, the weak trading volume in the Amman Stock Exchange, the low stock prices caused by many reasons, and mainly postponing the cash dividends for banks in 2020, and plus reducing the percentage of distributed dividends by some other companies listed in Amman Stock Exchange. Also, the tourism and transportation sectors were the most affected by the pandemic. These outcomes would have been much worse if it wasn't to several economic measures adapted by the government through a central bank and the Social Security Corporation. These measures added up to about 3 million dinar, Jordanian dinar, which is equivalent to around 4.2 million US dollar. That is around a big number of the economy. As for the year 2021, our economy started to pick up, thanks God, and GDP growth slightly in the first and second quarter. Unemployment also, we can see a slight increase, although at the beginning of this year it reached 25%. So we have unemployment rate of 25%, which is a big challenge for all the country and the economists and the government. All of these economic developments created the pandemic, by the pandemic have aggravated the challenges facing many pensions funds in the region, including our social security organizations. Programs in many countries, including Jordan, has limited the inflow of funds. In fact, for almost 2 years, what we are receiving from the social security is almost zero. All of these challenges put a huge pressure on pension funds and the managers to redefine their investment models and the strategic allocation of their assets, hopefully to overcome these challenges. For us at SSIF, thanks God that the diversification of the portfolio has mitigated the negative impact of the unprecedented challenges that the pandemic had on the economy. We have witnessed a growth in our investment return. Accordingly, our assets grew from 11.2 billion JD at end of 2020 to 12.1 billion JD as of end of September 2021, which is equivalent to 17 billion US dollar. As our allocations were primarily in government bonds and with a stable return or fixed return, and also we have many blue chip bank stocks along with blue chip industry stocks, primarily phosphate and potash. But I must admit here that our tourism sector was hardly hit as we expected, and just like the rest of the world, we we have good investment in the tourism sector. This pandemic certainly highlights the importance of investment diversification, not just in different asset classes, but in geographical, regional, economical, and currency market as well. This pandemic has exposed so many loopholes in transportation, shipping, and other types of logistics. Hence, the need for geographical and regional economic diversification has become stark, clear, and a must-do for pension funds. As you know, that all our investments are local and in Jordan. So after the pandemic, we felt or we are more decisive as a fund and our board that there should be more diversification outside Jordan. And due to the economic slowdown of the country and its fiscal constraint, the Social Security, as I said, has come to the rescue with different programs that were well adapted and adequately suited the employer and the employee as well. And the Social Security Corporation has certainly played a dynamic role throughout the pandemic and its recovery period, which is still unfolding. As for the SSIF, we gave breaks to our real estate tenants, and we have actively contributed towards the economy throughout our diversified investment arms and board of director post. Also, we steered our investment toward agriculture, infrastructure, water, and energy sector. So now we have a new agriculture project. After the pandemic, we established a company, and the project will see the light next month. Also, we established a company with the banks to find it's 50% owned by us and the same by the banks to finance any infrastructure projects, because of the slowdown in the economy, we see that the solution now is investing in infrastructure. It will stimulate the economy. Of course, a feasible infrastructure project. It will stimulate the economy, create more jobs, and at the same time, it's a profitable project. Also, the water, because we have a major problem in Jordan in water. So we're working with the government to finance a desalination water treatment from the Red Sea to provide Amman with drinkable water. And this will see the light maybe after 5 years, but we're still in the pre-feasibility studies. And so all the projects came out after the pandemic. I will stop here, and I don't know if I answered all the questions, Farah.
Yes, perfect. Thank you, Your Excellency. Abdellatif, maybe I can switch to you now as a former government pension fund CEO. Now you sit on the other side of the table as an investment expert with a clear understanding of the challenges that pension funds are facing. Can you maybe set the stage for us in terms of the investment landscape as you see it today? We're in a very low-yielding negative interest rate, in some places negative interest rate environment. There's rising or transitory inflationary environment, and historically the longest bull market we've seen for over 10 years. And you mentioned in the past the need for more efficiency. So how do pension funds position themselves for the next decade?
Sure. Thank you, Farah. That's a very good question. Well, markets have been very generous to us over the past decade, and since the global financial crisis, the great financial crisis, where we saw returns for institutional investors were very healthy, and a lot of pensions were able to meet their obligations during that period. We saw markets and equities doing very well. We saw fixed income yields tighten, and therefore asset prices went up. And we saw yields also across asset classes tighten further, implying a better return for investors. So a diversified portfolio for institutional investors served them very well over the past decade. And the question is, where do we go from today? Now we are faced, as you mentioned, with low interest rate environment. In fact, many sovereign fixed income instruments are yielding negative real yields. We see equity markets at elevated levels. If we look at the multiples across markets, they are above historical averages. If we look at other asset classes, their valuations are also on the higher side. So the expectation going forward will definitely be for lower yield or lower return environment for a diversified portfolio, given the starting point that we have today. Now, the question is, what do we do if we are in a different environment where inflation becomes a threat? And we are seeing inflation today at around 6% level. Now, most of it hopefully is transitory and should go away. But the question is inflation expectation will remain with the consumers and producers alike, whereby inflation levels are going to be higher going forward than they were over the past decade. If we look at markets, they are pricing that. And so the investors today need to really think about these challenges, what to do about their fixed income portfolio that is either low yielding or even providing negative real yields. What to do to hedge against inflation if that materializes going forward, and how to position in equity markets given the elevated prices. And finally, how to handle their alternatives. If we remember, institutional investors were migrating and increasing their allocations to alternatives in the past. I think today it is crucial for them to increase it even further, because it is one of the areas that is still providing reasonable relative return compared to publicly listed asset classes. So I think today investors have to be nimble, quick to act. They have to ensure that they have the right portfolio for the environment we are in, to hedge against risks that exist today that might not have existed before. They need to consider more complex investments, such as in alternatives or other complex instruments and investment strategies, such as quantitative strategies that provide reasonable returns, but with very efficient cost structure associated with them. The other thing that we have seen over the past decade is that passive strategies work very well, and in fact have provided investors with good returns at a reasonable cost. Now, where market volatility is increased, where the different sectors and companies' valuations are, let's say, has some dispersion within them. The question is active management going to be back again? And that might be something to consider, to think about active management and maybe get some exposure through that, because I believe that good active managers will be able to provide good alpha to investors. The final point I want to mention is that investors today have to be more efficient as well. So they need to consider their operational alphas. So think about securities lending and how to squeeze that and provide some returns from it. What to do about the investment execution costs and how to reduce those costs associated with investments, how to renegotiate with their managers and fund managers the fees associated with investments, given the low return environment we see ahead. So these are all the challenges that we are faced today that might be a bit different than what we saw in the past decade.
Thank you, Abdulatif. I mean, you brought up a lot of challenges facing the industries, and I wonder, maybe you can add a little bit more about what do you believe are the solutions, because we talk about operational efficiency, the operational alpha, you talk about active management. Are there enough products in the market? Are the solution providers ready to create these so help the pension industry solve the problems they're going to face for the next decade?
So these are definitely not full solutions, but at least they help improve the cost structures of pensions and improve the return prospect from their portfolios. But yes, the products are available and scalable in the various things that I mentioned. And I think that active management is there to provide good returns, but you have to ensure that you are with the right managers, that they have the right alignment with the investors, and if you are so, the alphas associated with such strategies should benefit investors.
Thank you. Dr. Alistair, maybe I can turn to you now. It would be really helpful for us and our audience, maybe if you could give us your views on global markets and the impact on asset allocations that you're beginning to see or you've been seeing over the last 18 months in the developed and the emerging world. And specifically, maybe if we focus on government pension funds, are we seeing shifts in strategic asset allocation for the next decade, or are these just tactical shifts that we're seeing in these large funds?
Yeah, great. Thanks, Farah. And very pleased to be at the conference today. Disappointed not to be in Bahrain like I was 3 years ago, but still very happy to be on the agenda. And obviously the theme for the conference is this idea of pension funds have done very well over the last 50 years. Positive environment, disinflation, economic growth, rising valuations, so high nominal returns. And the backdrop, we're certainly seeing that returns in the future will be lower. Just to put some of our forecasts out there on a 10-year view, this is in dollars, and assuming inflation averages out at about 2%. So we do have a blip, and then we go back to where we were before. We'd be seeing global equities somewhere about 5 to 6% long-term returns. Emerging market equities might be something like 7%. Point has already been made about fixed income, so US Treasuries less than 1%, some other markets lower than that, and even something like high yield, the orders of 2 to 3%. So a very different environment from the one we've been in. It definitely does have implications for pension fund asset allocation strategies, and I think one thing, it's not clear that taking much more market risk is the answer. If schemes go and they just think, well, we're just going to have to put more into equities to respond to this, and they go beyond their risk tolerances, that tends to be something that people regret. But there's lots that we can do in terms of looking at the asset allocation, as you mentioned there. Strategically, it does come down to diversification. I agree a lot of things that Abdulatif was saying there. And as you diversify widely, I think for some pension funds, the issue is regulatory constraints and limits on the extent to which they can diversify, and particularly the extent to which they can invest outside of domestic territory. So I think there's a strong case for lobbying against that and looking for wider investment power, so as you can use global equities, emerging market equities. You can really do the full spectrum of fixed income across government, corporate, high yield, emerging market debt. And I agree also, selective use of active management, trying to add alpha, increase returns. I think you be careful about where you do that and where you'll get the payoff for it. Some areas where theoretically active would add value, let's think emerging market debt, where in practice that hasn't really come through on average, so need for care there. Factor-based approaches, giving a sort of, somewhere between index and active and more systematic at lower cost. And again, as was mentioned, private market allocations, although again, careful of the costs. There's definitely good returns to be had there, but there's also often quite high fee levels, so just looking from a balance there. You mentioned tactical. I think the tactical thing we're seeing is that concern about inflation and whether there's a pickup in inflation. And what we're seeing is some interest in real assets as a hedge to that. So, REITs, infrastructure, commodities, natural resources, some of the inflation-linked bonds, although yields there can be quite low as well. So that seems to be the sort of tactical thing in our view is, you are seeing a pickup in inflation. We think that will be somewhat persistent, but the central banks will get things back to target in due course. So we wouldn't think it's a new environment. The low return environment, we can talk about what we do in the portfolio. I think one other thing pension schemes need to look at is costs. If returns are lower, then there's much more pressure to manage your costs. So it's already been mentioned, use indexation to bring down management costs, particularly in markets where alpha is less achievable. And we're also seeing around the world consolidation, pension schemes aggregating, merging, and attempting to get economies of scale. And I think that's very important in a low return environment, that we get efficient organisations that can benefit from that scale. And fiduciary management would be another sort of means to that, where we're seeking to get that aggregation. And then just finally, just to close it off, this is an investment panel and that's our focus, but the low return environment isn't going away. And there are some realities out there in terms of the pension scheme members are living longer, they're living healthier lives. In a low return environment, people are probably going to have to work longer and retire later, and we're going to have to move pension ages. We're probably going to have to contribute more to pension funds during our working lives. None of that is politically very attractive, but I think it's the reality. And I think, as I said, there's only so much that the investments and the cost reductions can do, and some of those more structural issues need to come to the fore as well. But that's not for our panel, but I thought I'd just put that out there, and I'll stop there.
Thank you. I mean, you brought up a lot of very interesting points, and I guess, it's a combination of the investment piece, structural changes, culture. Clearly, when you have consolidations in pension funds, you're also going to have cultural issues. People living longer. We're already seeing pressure on pension systems in some of the developed markets like Japan and other areas where you have an aging population. I guess in this part of the world, where you still have probably 70% of the population below the age of 30, there is still probably less pressure on the liability side. But I wonder if you can maybe talk a little bit, Dr. Alistair, to the differences between what you're seeing in maybe the developed markets and maybe the Middle East. Is there something that the pension funds of the Middle East can learn from the developed markets, or is it structurally very different?
I think the big structural difference is the move to defined contribution. So in a lot of the developed markets, the defined benefit plans are closing and becoming frozen, and DCs taking over, and investment strategies are becoming very different on those two sides. On the defined benefit side, much more an emphasis on de-risking, managing liability, fixed income being the predominant asset class. And certainly in the UK, I talk about the end game, that these pension plans will be closed within 1 or 2 decades, and it's about the sort of risk management that gets them through to making the payments to their last members. And then on the defined contribution side, then much more about growth, investing for the future, and particularly sort of life cycle investing, where for younger members there's a high growth portfolio, and for those closer to retirement there's a more defensive portfolio. But I think that sort of structural change is the interesting one. And I know that trend is, there's some, I've seen some evidence of people who can set up defined contribution plans in the region, but that's still quite kind of early days.
Okay, perfect. I I think we're just waiting for Karim to join us, or is Karim with us now? Karim is here with us. Can you connect now? We're having tech issues, or we're okay, Karim?
Can you hear me?
Yes, we can. So Karim,
Excellent.
I hope you've been able to listen to the panel so far.
I have been. I've been on from the start, but my
Excellent.
microphone on the desktop hasn't been working. But now on the phone it's working, so we're all good.
Perfect. Okay. So I mean, we've heard from Her Excellency, we've heard from Abdul Latif and Alistair about the various sides of the table they sit on, the kind of economic climate that we're in, the investment climate, the challenges that some of these government pension funds are facing. And I wonder from your side, as also a provider and a servicer to many of these pension funds, is the, we talk about the 60-40 asset allocation model, the traditional equity fixed income model that pension funds have historically followed. Is this even viable anymore for the next decade? And what are the investor trends, demands that you're seeing at BlackRock as the largest global asset manager today?
Yeah, thank you for that question. I think it's a very, very important question to be asking at this juncture, and I'm really happy to be joining you today from BlackRock's offices in London to talk through some of these themes. So, as you alluded to, with a lot of our work with pension funds, asset owners, there's a conversation around this 60-40 allocation that you're talking about and how to move forward from that in an environment where, on the fixed income side, rates are extremely low globally. Especially in Europe, we see this where rates are even in negative territory and don't seem to be moving anytime soon. And then on the equity side, an environment where volatility is starting to pick up slowly but surely, and where we're seeing questions around central banks starting to look at potentially tightening policy and more elevated macro uncertainty. So with those topics in mind, as we look at long-term strategic asset allocation and the sort of equity bond allocation, a couple of things that really come to the investor mind's forefront, which is diversifying your diversifiers. So in an environment where, since the global financial crisis, year after year, stocks and bonds have been strongly positively correlated, what does it mean to have an equity bond allocation? Is that enough to diversify, or do you need to look at an alternative sleeve? This alternative sleeve could look like private equity. It could look like infrastructure, real estate. What sort of exposures in alternatives does an investor need to look at having in order to diversify your diversifiers? And then also going further afield to look for yield. So here, emerging market debt starts to really come through as a theme for searching for income. And then the question is, do you go for local currency or hard currency emerging market debt? And what does that profile look like? Especially within emerging market debt, one area that comes through strongly is Chinese debt. So China bonds, for example, in the ETF space have been one of the... so we launched the China bond ETF in Europe, and it was the fastest growing UCITS ETF that we've ever launched in Europe, and is now above $10 billion in a very short space of time, only a year and a half, 2 years, which goes to show how big of a theme it's been to look at search for yield in emerging markets, and especially in China, where yield levels on Chinese government bonds are near 3%, when still remaining pretty low on the volatility front. So a pretty stable source of income. And then other long-term themes to think about when thinking about this equity bond allocation are sustainability. So we're seeing ESG flows in the ETF space surpass $120 billion this year, which breaks the $100 billion record that they set last year in 2020. And we really feel that we're only scratching the surface here when it comes to sustainability, with the carbon transition still, in its early days, and with a huge focus from investors on how to position for it and how to reward companies that have a plan around this carbon transition on a long-term basis versus companies that do not have a plan. So, and then lastly, the point I wanted to make is around inflation hedging. So on a long-term horizon, we're now starting to see inflation really come through. We had the UK CPI print today at 4.2%. We had the US CPI print last week at 6.2%. Bumper numbers reflecting that inflation is really here to stay as we look at, the environment beyond the economic restart from the COVID lockdowns and pandemics. And when we look at this environment for inflation, the concept around what to position in portfolios for inflation hedging and inflation resilience really starts to come through. So thinking about exposures like in commodities, gold and gold producers, which also work for diversification, but also thinking about exposures in equities, diversifying across cyclicals and defensives, diversifying across the barbell when it comes to factors, across quality and value factor, and in fixed income, thinking about inflation-linked bonds. So going back to the point around bond allocations and diversifying your diversifiers, how much of your bond allocation, your duration allocation, should actually sit in inflation hedged bonds as opposed to nominal bonds in an environment where inflation is coming through. And so to sum up, you asked me about the equity bond allocation and what that looks like on a strategic horizon with all these changing macro factors. And I think it looks like asking ourselves the question where to search for income, how to hedge for inflation, how to diversify your diversifiers in an environment where the correlations between equities and bonds are atypical, and how to position for the journey to net zero in terms of sustainability.
Thank you. Thanks, Karim. That's a lot of information for people to absorb. And I guess what I'm beginning to feel is there is a lot of change that is demanded of pension funds and the way they diversify their diversifiers, whether it's new asset classes or it's more complex structures. And I wonder whether you feel from your interactions or BlackRock's interactions with some of these pension funds, are there going to be issues with education, I guess, and understanding at the IC level, at the board level, policies, that are going to have to change for some of these newer asset classes that didn't exist before or are being revamped, or how will some of these traditional dinosaurs of pension funds, if you like, deal with their new focus and new asset allocation?
Yeah, I think we often tend to underestimate the innovation, the element of innovation, in which is actually a big part of human nature and a big part of investing. And we often only identify innovation in hindsight. So I wouldn't underestimate the power of innovation, even in this client segment, in this investor segment of sort of longer term pension fund asset owners. And there's an expression that in English, which also exists in Arabic, which is that nothing is better for innovation as much as duress, right? Innovation in Arabic, al-haja al-ikhtira', right? So and we certainly have a lot of necessities right now. So we have needs to meet long-term income targets, which are becoming more and more difficult to achieve. We have needs to meet long-term diversification targets. We have needs to meet risk-reward and risk-return targets. And all of those have become more difficult to achieve, especially on a strategic horizon. Combine it with some of the other challenges that pension funds have to deal with globally, and some of them maybe are less relevant to the region, some of them are more relevant to the region. But my esteemed co-panelists already talked through a lot of these challenges earlier. So when you combine all these needs, all the necessity is great, haja is great, and so innovation, اختراع, has to match it. And so what does this mean? It means steeper learning curves that we need to get on in order to understand maybe spaces that are less familiar, like having a bigger alternative sleeve in portfolios, and studying that sleeve better, and going further afield to get that lower correlation with public equities. We have a steep learning curve when it comes to learning about how to hedge for inflation. The reality is that a lot of investors today have not lived through a high inflation environment. The most comparable high inflation environment that we've seen, it was in the 1970s. A lot of us were not in our careers back in the 70s. So it's a steep learning curve for this client segment, but also across all client segments, to learn how to deal with a rising inflation environment. Now, the comparison with 1970s stops there. I don't think it's a fair comparison apart from inflation levels, because back in the 70s, we had sort of a stagflation scenario, which we by no means do we predict to be happening right now. We don't see ourselves going into economic stagnation. We don't see ourselves going into a tough growth environment. In fact, we're quite constructive on growth over the next few years. And even with the higher inflation environment, we do see good fundamentals and a good environment for risk. Equities are probably going to still produce positive returns, but it's just that the environment is a bit more challenging than the past 10 years. So I think, in short, to answer your question around this, the answer is innovation. The answer is coming to terms with steeper learning curves, and we're gonna have to learn. And even the dinosaurs will have to learn. They have no choice, because the targets are so difficult to achieve if they do not.
Thank you, Karim. We've had a polling question, I believe, in the background to the audience. The question that was posed was, will the next 50 years generate higher returns, lower returns, or the same returns, or unpredictable? And I don't know if we have the results of the poll to discuss or to maybe pose to our panelists. So we have, the percentages are coming through. So 33% is for higher returns. The audience believe that 22% will be lower returns. And our colleagues are typing very slowly, so we're not seeing the rest of the results. And so maybe 44% unpredictable. Interesting. So Your Excellency, maybe I turn to you, I think, with the conversations that we've been having here, and I guess maybe picking up on Karim's last comments around innovation and the steep learning curve. We are in a new era, and I guess you have pressure potentially from various stakeholders. Will you change the way you potentially allocate? Will there need to be changes to investment policies? Have we lost Your Excellency, or are you still here? I don't see the picture on the screen. We may have just lost Her Excellency. Okay, I will go back to that question. Dr. Alistair, maybe I go to you before we go to Her Excellency. I know you've mentioned that when we look at ESG, which seems to be a train that is going at full speed right now, and even the Middle East, that was not that focused on ESG a year ago, I think is beginning to pay a lot more attention to the ESG space. I think SSGA, in our conversations, looking more at an engagement strategy or more stewards of capital. Can you maybe explain a little bit about what's needed for investors to really move the needle to become more sustainable?
Yeah, certainly. It is a topic that's occupying a lot of our day-to-day conversations with clients around the world. Strong interest in ESG and quite a change, as you note, particularly in some regions where many pension funds would have said, well, I can't do ESG, that's not my job. My job's to focus on returns for my members, to look at the financial interests of the members. And that's really changing. And I think there's a growing understanding that ESG is about risk management, and risk management is very much the business of pension scheme managers and something that they should be focused on. It does vary regionally. We see the leadership, but the US is starting to catch up now that the regime has changed and the government tone is different. And as you say, seeing a growing level of interest across the Middle East. The big shift recently has been to focus on climate. So whether there was a discussion about broader ESG, focus very much now on climate change, and we're seeing major pension funds, pensions organisations making net zero pledges and then starting to map out what that means in terms of the journey that they have to take. And I'll come on to the point about stewardship in a minute. But we are seeing moves to climate aware portfolios. So rather than, let's say, holding the whole index, thinking about approaches where you're emphasising more less carbon intensive companies and businesses, or companies that have got a much more clearly mapped out transition plan, or potentially beneficiaries of the transition to a low carbon economy. So we are seeing people moving allocations and picking up different strategies. But we are definitely also seeing that interest in asset stewardship and a belief that the climate transition isn't necessarily about exclusion. It's not about taking certain stocks and no longer holding them, but it's about working with those companies on their transition plans, on the developments they will make to be part of the changes that we need to make in the economy in relation to climate change. So that's our voting and engagement, engaging with companies about what their plans are, what the transparency and disclosure is, and then challenging companies where that isn't at the level that we think it is, and ultimately voting against resolutions and directors if we're not seeing the progress. And we have much more time explaining our policies and accounting for our track record on stewardship with our pension fund clients than we were even a few years ago. There's a question, what are the barriers, what are the obstacles? And I think where we're at the moment, there's really kind of good momentum. Things are picking up in that fact. There's much more focus on ESG. Probably still a little bit that residual skepticism about, my job's to get returns, but that really is waning. And obviously there's discussions around greenwashing. I think that can hamper kind of focus on the real efforts that are underway. But certainly a real trend, and a real trend in all the regions and all the markets that we're active in.
Thank you, Dr. Alistair. And so one of the questions that came through from the audience, which I believe you already kind of addressed, but if you're dealing with climate change from an investment perspective, is your answer the engagement, the stewardship, and really trying to drive the conversation around where are firms reinvesting their capex?
I think that's a key focus. So we do have investors looking at climate strategies that actually change the holdings, and often that's about tilting. So it's not about excluding. It's not about saying we're not going to hold these stocks, but we're going to overweight the stocks that have either good profiles now or that have good transition plans, and underweight those that are laggards. And then that can be dynamic, and as companies improve, then they're eligible for higher weighting. So we're definitely seeing new investment strategies come to the fore, but alongside that, the focus on stewardship, because even if you go down an exclusion or a tilting route, there's still many other stocks in the portfolio, and you need to have a dialogue with them and they need to be part of the transition as well. So short answer is it's probably both.
Perfect, thank you. Your Excellency, welcome back. We had some glitch there with the technology. So I guess the question I was asking you before you got cut off was, the Dr. Alice has just been talking about the ESG space, greenwashing that now has become a thing of the past, and the demand by many of the different stakeholders for sustainability and ESG to be much more visible and more measurable. And so I guess from your seat, are you beginning to see a demand from your shareholders, your stakeholders? Is there pressure for you to start to change the way you invest and whether it's the governance structure or how you address and frame this problem, and how do you create a solution within the fund? Will you change the way you allocate capital?
Yes. Yes, as you know that now, as you said, that many in the financial community believe now that the pension funds are ideally placed to incorporate and governance ESG principles when they make investment choices. Nevertheless, pension managers also face threats if they fail to do it thoroughly. For us at the SSI level, there is no pressure to use ESG, but we're hearing this term everywhere we go. And for example, if we want to do a feasibility study, now we have to do the environmental impact. But for us, we already have so many principles. For example, our motto has been to invest responsibly since 2010. Since then, we have incorporated the CSR impact on developing the business environment as one of the institution core values. Also, SSIF has been conducting many initiatives reflecting the ESG, namely corporate governance. We issued a manual for all our representatives about the corporate governance inside the fund and outside, and what are the roles and responsibility being members at the board. Women empowerment, also we had issued a document on women empowerment, and we started 2 years ago a full program with UN Women to build capacity of our ladies to enable them be more active when they sit on boards and to empower them more. Paper recycling, we won a prize, the country prize last year for the paper recycling, and staff empowerment as well, not only for ladies. We're conducting a full program of training to build the capacity. So all of these comes within the ESG. Several forces has pushed sustainably that to the top of the institution's agenda. Pension funds and institutional investors and financial market are increasingly, as I said, demanding a compelling environment, social and governance plan. As part of the business context and the Jordanian economy, we recently also drafted our strategy for the coming 3 years, 2022 to 2024, and we identified in it the current sustainability positions and the key actions that we will get that will get us closer to adopting the SDGs and the ESG practices. So we will start also accordingly address all the key variables in the sustainable equation: carbon emissions, financial performance, capital investment, and social impact. We then will diagnose the current sustainability positions, establish a quantitative baselines, and define clear aspirations and design actionable sustainability plans. As for the governance structure, as you know, we have our investment board, and then we have a regulatory board, which is the Social Security Corporation board, which I sit on it, and the 4 of our investment board also sit on it. They're doing their best to clarify the duties and powers, to clear define lines, authorities, and responsibility between the two bodies. But as long as they approve our strategy and approve our budget, we have interference, but luckily we are that 4 of them are shared between here and there, so we can convey all the messages that are. So to answer the question, yes, we've been addressing the ESGs. Some of them were already implemented. Some of them are now within our strategy, and you hear the ESG everywhere you go now in Jordan. It's the new term, and I think by the coming 3 to 4 years, we will find most of these ESGs implemented within funds and within the public shareholding companies, at least, that we have shares in it.
Thank you, Your Excellency. Abdulatif, maybe I can turn to you now as you start to build a business that is really focused on creating solutions for the next decade. And how do you incorporate, or will you incorporate, ESG into your solutions, your investment solutions? I mean, is the Middle East investment landscape ready for this? Is it a demand from investors? And maybe I can incorporate one of the questions from the audience around oil as an asset class. Is this something that can be, I mean, how will we address it? We're talking about renewable energy. Is oil an asset class? Is something that, you know, will be considered that we have to diversify, continue to diversify away from, not just from governments, but also at the product level? And do you differentiate, a lot of questions all in one go, do you differentiate the E, the S, and the G?
Sure. There are 2 reasons to consider ESG as an investor. One is, obviously, we are all citizens of this world, and we want to ensure that we have something that is sustainable. And so that's one of the reasons that many institutional investors are adopting ESG. The second reason, which is relevant everywhere, is that with ESG becoming a strong trend, obviously it is having its impacts on markets and companies' valuations. And so companies that are more that score higher on ESG definitely has a premium over companies that are less compliant. So we at Sabine Investment Company are very conscious of ESG and definitely consider such factors to know how are these companies operating, and to know what will be other investors' view of these companies and who might do better just because they're scoring higher on these metrics. Now, in terms of the market demand in the Middle East, more investors in the Middle East are becoming aware of ESG. Now the adaptation for such strategies maybe is on the lower side relative to our counterparts in Europe or the US for that matter. Yet we are seeing investors learning more about ESG, how to incorporate it into their investment process. And I think going forward, we might see more adoption of ESG in the region, and therefore managers such as ourselves will have to ensure that they have a view of ESG, how to consider it in their investment process, how to build products around it to ensure that they are catering well to their clientele base and ensuring that their requirements and needs are well served. Now, when you asked about the differentiation between the E and S and G, I can tell you that on the G part, we are very focused because we believe that the G part drives a lot of value in companies. Companies that are strong in governance usually have more stable operations, more stable decision-making process, and hopefully perform better than companies that have worse governance practices. And most importantly, companies that don't have good governance, they always have this tail risk of a blow up or a permanent value destruction in the company. And so definitely when we see a company, even if it's operating well and have good profitability, if the governance structure has an issue, or we don't fully trust that they have the right governance structure for their business, we will definitely avoid it. And so this is a main factor that we consider in our investment process. In terms of social and environmental, these are complementary and definitely have some value-adding companies, yet remains to be seen how much value can they derive in the company's operations and profitability going forward. There was a question about oil, as you mentioned. Well, now, if the question is about investing in oil companies, I can tell you that investing in oil companies doesn't mean that you're violating the ESG. In fact, if we look at Saudi Aramco, which is mainly a producer of oil, but does have production of gas and petrochemical and has other operations, it scores reasonably okay on ESG. Because even as oil producers, you can always do things to basically help the environment, whether it's through carbon capture, carbon emission capture programs, or building your plants to environmental acceptable standards. And so it's not a pure yes or no. If you're an oil, you're not ESG, or if you're not oil, then you are. And the most important aspect of that too, even as an oil company, do you still define yourself as an oil company, or do you define yourself as a power company or energy company that might shift its operation from oil and diversify into other environmentally friendly or friendlier energy sources? And so if you are, that means that you're on the right track and you might fit within ESG.
Thank you. That's very interesting information. And I'm going to turn to Karim now. We have a couple of questions coming through the audience, so I'm going to try and weave them into the question to you. I think you have some information that you'd also like to share with us on some of the ESG metrics and how that affects your capital market assumptions. But maybe we can also take that in relation to one of the questions that's been asked around this low-yielding environment and what does that mean for pension funds in terms of their investment philosophy? And if we were to kind of include sustainability on this, does that mean that pension funds have to actually significantly change their investment philosophy? And then as an addition to that question, maybe if you also look at the platforms that are coming out where individuals can access retirement savings plans, do these now savings plans have to be able to offer target funds? Do they have to be investment solutions that include ESG metrics or focus? And maybe I can leave you to pick up those two questions. Or three. Karim, I think you're on mute. We can't hear you. We don't hear anything right now, so still mute is on and off, but we don't really hear you. No, don't hear anything.
I'd be happy to take the target retirement one. So that's an area that we're quite active in. So yeah, around the world, we're a big player in defined contribution retirement savings plans, and yeah, very much the target date, target retirement funds are a key strategy. We're managing over $100 billion in that strategy around the world. And I think that the reasons from a member point of view, it's simple. You have a single fund, it matches your retirement age and you're sort of delegating the investment strategy to the plan and the manager. So it's nice and easy for the members, and members can be easily confused by investment choices. It's very simple for the plan administrator, one fund per member, grouping members into cohorts by age, again, very simple. And then underneath that, you've got an age-appropriate investment strategy where the level of risk varies from, high growth focus for younger members through to more defensive when people get retirement. So it's a nice package solution. As a result of that, we've seen strong growth in other markets. So as retirement savings plans take hold in the region, then I think target date funds are a key part of it. And increasingly, target date funds will incorporate ESG for the risk management reasons we've discussed, but also because the members often value that as well. They have preferences and values that they want to see reflected. So I think that will be a key trend.
Thank you. And thank you for stepping in there. I don't know if we have Karim back with us on his voice. And Karim, are you back with us? Not really. We cannot lip read. We don't hear you. Let me. Maybe we have 5 minutes left until we get Karim back. Your Excellency, in the last few minutes of the panel, can you maybe share with us your biggest challenge, what you believe is your biggest challenge as a fund over the next 10 years?
Yes. As you know, or as I had said, that we're the biggest fund in Jordan, and we're around 35% of the GDP, and still we're growing. The main challenge is that, according to the strategy and to the board, all our investments are invested locally within Jordan. So we are very much impacted by the economic situation of Jordan. We don't have the diversity and geographical diversity to mitigate the risk of being concentrated in one country. This is one of the main challenges that it may be, by the way, it may be positive or negative, but still it imposes, because it helped the fund throughout the 17 years. But looking forward, it may be a very big challenge. The other one is the Social Security Corporation funds. As you know, that 55% of the growth in the assets were from the investment returns, and 45% from the surpluses from the Social Security Corporation. Now, because we were a very youth society, and when the Social Security Corporation was established in 1980, 50% of the population, Jordanian population, were below 15 years. So you can imagine that how many people were at that time paying, and very few people were receiving retirement. Now, it's the demographic changes are affecting this, and you're seeing much more people receiving retirement, and still the number is increasing. But in 10 years, we will, if also the slowdown in the economy continues, then we will be paying more than receiving. So this is another challenge. The other one is, as you know, that the risk profile of our pension fund is very low. So that's why we're investing in government bonds and money market, direct loans to government, and leasing. This by time, I don't think we will be able to achieve the returns that still it's debatable, but this one of the challenges that I may see in the future if we don't enter in profitable projects to achieve more returns. We cannot depend always on the fixed assets returns. These are the main challenges that I face.
Thank you, Your Excellency. Thank you. Abdul Latif, maybe I can turn to you. for a similar question. You've been on both sides of the table. And what do you see as the biggest challenges from the seat that you sit in today for the next decade?
Sure. I'll keep it simple. Truly, with the starting point of elevated asset classes valuations of today, it's hard to envisage that the next decade will have the same return profile as the last decade. And so the biggest challenge for investment managers such as us at Sabine Investment Company is to be able to replicate the returns that have happened over the last decade and ensure that our clients are satisfied with the returns. Obviously, we will work hard to generate alpha and add the returns through different strategies to compensate for the lower beta returns that the markets might offer. But that remains a big challenge for the asset managers such as ourselves.
Thank you. I think we lost Karim again. So, Dr. Alistair, I'm going to turn to you. We've had a lot of information in this panel, challenges for all different stakeholders. And I guess from your seat and your experience, what do you see as the biggest challenges for the next 10 years?
I think the biggest challenge for the next 10 years is climate change. I think it's about creating portfolios that facilitate the transitions we need to make in the global economy to a low carbon or more sustainable environment, and creating portfolios that capture the benefits from that transition, that manage the risks from that transition. So I think that's the key thing. We're already busy working on those issues with clients, and I think that's only going to increase. So I think the point about the low return environment and the issues of that stands, but I think the new frontier is really dealing with climate change.
Thank you. Karim, do we have you back with us?
Yes, can you hear me?
Yes, we can. Perfect. Thank you. So I guess in the last couple of minutes, maybe you want to kind of share with us from all the conversations we had, what does all of this mean in terms of the impact on your capital market assumptions, and what do you believe are the biggest challenges for you as the largest asset manager as you sit and watch the global landscape and pension funds as they kind of maneuver their way through these challenges? What do you believe are going to be the biggest challenges for the next decade?
Absolutely. I think from capital, some of the biggest
Karim, we're losing you again. You're breaking up. We've now lost you again. I don't hear you. I'm going to start summarizing our panel, but if you get voice back, please jump in. And so we've had a lot of information on the table. I want to thank our esteemed panelists. We've heard everything from the challenges that alternatives are going to play in portfolios. Where do we look? How do we diversify the diversifiers? The challenges around operational alpha.
Yes, can you hear me now?
Yeah. Oh, perfect. Thank you. Yes, Karim. Go ahead, jump in.
Yes, sure. So sorry, I'll pick up from some of the themes that you were just outlining, and apologies for this connectivity issue. It's funny when I'm working from home, my connectivity is often better than when I'm returning to the office, which is really interesting in the context of the return to office from lockdowns and COVID. It's speaking of challenges. However, when I think about the longer term challenges and impact on our capital market assumptions, the first impact on our capital market assumptions, I'm going to borrow Alistair's answer, which is on climate change. So some of the biggest impacts over the long term is we've started to produce what we call climate aware capital market assumptions, which basically look at how our assumptions on transition to net zero in terms of carbon emissions, how that would impact our asset allocation and our capital market assumptions over the long term. And there are some key themes that come through. The first, on the sector level, we see sectors that have low emissions as well placed in equities. So technology, healthcare, and financials are three sectors that stand out as strategic overweights in terms of having low emissions and being well positioned for the journey to net zero over the long term. Then we see superior capital market forecasts, so superior returns expected from developed equities, specifically Europe, and from select emerging markets such as China, where we see that valuations are very cheap at the moment, which makes them well positioned on a long-term basis because there's a lot of risk premium priced in these markets. So basically, despite having significant risks on the horizon, you're already being paid for those risks in terms of the valuations in those equity markets. And then on the broader level, I think when I think about the biggest challenge for 10-year horizon markets, it comes back to the point that you were sharing, Farah, around diversifying your diversifiers. And in that context, trying to identify what correlation framework we are going through in terms of equities versus bonds versus commodities, and also identifying whether we have started to see an end to secular stagnation, which has been the key theme for the economy in the past 10 years, now that we're seeing inflation come through, or whether secular stagnation is here to stay. I think answering that question is probably the biggest challenge for investors for the next 10 years because it has significant ramifications on market returns.
Perfect. Thank you, Karim. So I'm going to go back to summarizing, and I want to thank our esteemed panelists for all their contribution today. It's been a very interesting conversation. And really, in summary, I think there's a lot on the table from the role of alternatives, operational efficiency, operational alpha, the funding gap, and the need for increased returns over the long term, passive and how it's worked historically, and how we now need potentially to shift to much more active management, diversifying the diversifiers, which has been brought up a couple of times, the climate change as a huge challenge, and energy transition in portfolios, innovation, and how will innovation be implemented, the steep learning curves that will be needed across the board for many of our funds, and also, I guess, both sides of the tables, and potentially new targets that we need to meet. And maybe one last challenge by Karim, which is the tech challenge, that as we shift from a working from home environment back to the workforce, are we actually going to be functioning efficiently or not? And with that, I want to thank our esteemed panelists. Thank you to the organizers, and I will hand back to our organizers. Thank you.